Have you ever looked at an indicator and thought, this thing doesn't work, and then you moved on to the next one? Yeah, I also did that. Keltner Channel indicator is one of those indicators that I misused in the beginning of my trading journey. But you see, it's not the indicator that is broken, it's the way traders use it. Stay with me, and by the end of this video, you will know exactly when Keltner Channel gives you an actual edge and when it's just noise. Keltner Channel is a volatility-based indicator. It uses an envelope, basically a band above and below the price, originally built using a moving average and the range of the price. It was developed by Chester Keltner in the 60s. But most likely, if you are using Keltner Channel today, you're using the modern new version developed by Linda Raschke or Stark, where they use the exponential moving average and the average true range to build the indicator with its upper and lower band. Here is a chart showing the indicator on the S&P 500 futures. The orange bands are the original Keltner Channel indicator, and the cyan bands are the modern version of this indicator. Here is a comparison between these versions. So the original versions back in the 60s is what developed with the moving average of the typical price. Typical price is the high plus low plus close divided by 3. So this is the middle line. And then the upper and lower bands are the 10-day moving average of the range of the price. The modern version, and that's what most charting platforms use, is the one developed by Linda Raschke or by Stark. And it uses an exponential moving average for the middle line. This one still uses the simple moving average. But the differentiation here is they use an average true range with a multiplier instead of the simple moving average of the range. Basically, the modern version hugs the price better than the old version. In this case, I'm using same settings for both here. It's a 20-day look back with 1.5 times the average true range. And since I am an algo trader, I don't care how the indicator looks on the chart because I don't look at the charts and trade. I basically use logic to enter and exit trades. So what we are interested in is testing both these versions of the indicator on a market to see what works and what not. So the way we are going to trade with this indicator is as follows. We can either use it as a breakout or basically a trend indicator. So when the price closes above the upper channel, we go long, and we exit either when the price closes below the middle line or close below the lower band. Same thing on the opposite side. We go short when the price closes below the lower band, and we exit when it closes above the middle line or when it closes above the upper band. We will also test it with a mean reversion type of strategy, where we will go short when the price closes above the channel, and we cover when it is below the middle line or below the lower band, and we will go long when the price closes below the lower band, and we exit when it is above the middle or above the upper band. These are the most common uses of this indicator. And of course, that's where most students fall into this trap of forcing an indicator to work on a market or a time frame without understanding their market that they are trading. So let me explain. So first market I will test is the US dollar versus the Canadian dollar. I'm testing this market using the futures derivative. And here is what we will test. First, the method. It's either the original version or the modern version using the exponential moving average and the average true range with a multiplier. This is the length of the moving average of the middle line, and this is the multiplier for the average true range. So if the method is 1, then this doesn't count. If the method is 2, then we are using this multiplier. And then we have the strategy style. So 1 is the breakout methodology. That means if the price above the upper channel, we go long. And 2 is the mean reversion methodology. That means if the price closes above the upper channel, we go short. And then we are testing the short and long separately. All in all, we have 480 combinations. And these are the results sorted by return to drawdown ratio. And we see here the maximum return to drawdown ratio is 3.27, but number of trades is 24, which is very, very low. The test here is from 2006 all the way to October 2025. So that's more than 18 years, and 24 trades is just not acceptable. Now, if I filter trades above 100, so let's put it at 100, we can see now that all strategies that are sorted by return to drawdown are doing more than 100 trades. And we have 2.23 as the best, 2.22, and then we start falling down until here. So basically we have 9 strategies above 1, and then the rest are below 1, meaning the drawdown is bigger than the return. All these are short strategies, and we have here long strategies, and now the return to drawdown is 0.37. So let's keep this in mind. We have 9 strategies that are making above 1 return to drawdown ratio, and only 2 making above 2. And these strategies are making between $120 and $145 on average. And this is an indicator that measures the average true range in dollars. And we see here at the lowest, we are about $300. So the average trade is roughly half of the lowest point in the average true range in dollars. This is natural gas. And here we can see that the lowest point in the average true range is about $1,200. And this is the same optimization sorted by return to drawdown. Again, we are filtering below 100 trades out. So all these are above 100 trades. And now we have 139 strategies that are doing better than 1 return to drawdown ratio. Also, watch this. These are all -1. So all these are short strategies. And the average trade is 700. This is 300, 600. Mostly it's about 700. And remember, this was 1200. So basically, we are around 50% of the average true range. And this is the S&P 500 futures. And here, the lowest average true range is about $2,200. Again, we filtered all the strategies with less than 100 trades. And as you can see, they are all doing better than 100 trades. And here we have 158 strategies doing better than 1 return to drawdown ratio. And notice now all the strategies are on the long side. And if we look at the average trade, it's 900, 700, 600. And if we average all that out, we will be between the Canadian dollar and the natural gas in terms of the percentage of average true range in dollars. Like I told you when I started my journey, I thought it's the indicator, and I tweak the indicator and try my best and force it to work on a market or a time frame or a direction. But as you can see from this simple test, that it's not the indicator. It is actually the market that decides what works and what's not. So when we look at the Canadian dollar, we can see that only 9 strategies make better than 1 return to drawdown ratio, and only 2 strategies that makes 2 return to drawdown ratio. But when we switch to natural gas, we have more than 150 strategies doing better than 1, and a lot of them doing better than 4 return to drawdown ratio. And when we switch to the S&P 500 futures, we also came to the same conclusion, about 150 strategies making better than 1 return to drawdown ratio, and many of them are above 4 return to drawdown ratio, regardless of what settings in the indicator. Also, an extremely important distinction is all the good strategies are on the long side on the S&P 500 and are on the short side on the natural gas. And the Canadian dollar, basically no strategy, because we have only 2 and we cannot use them. And the conclusion of this test, it is not the indicator. You can try the indicator with all the values you like, with all variations you like. It's not the indicator, it's the market. The S&P market usually works really well with long strategies, works even better with mean reversion long strategies. And natural gas is the opposite, works really well with short strategies. And that is the foundation of my algo trading masterclass, is I start with market edge, because then it's very easy to develop strategy. You already know what is the tendency of this market. Now, if you come to trading with the idea that I want to short Canadian dollar, you're going to have a lot of difficulties finding a robust strategy that's going to work with Canadian dollar, because there is no edge there to exploit. Now, you have to dig down, you have to work really hard to come up with a robust strategy on the Canadian dollar, and you will find some. But even then, they are not as good as a robust strategy on the S&P 500 or natural gas. And here is where it gets interesting. So I'm testing the same indicator on the S&P 500 daily time frame, but now I'm using a mean reversion and a breakout using the same indicator. And testing the strategy, look at this. They are 0.3 correlated. This is the equity curve of the two strategies combined. This is the annual period analysis. Total number of trades is about 400, with about $860 average per trade. And the key takeaway from the portfolio is I want to show you that once you know the market edge, now you can easily deploy long mean reversion or long breakout. And these two strategies are not correlated. They are 30% correlated, which is like long and short, because they are timing the market differently, even though both of them are on the long side. While on the Canadian dollar, we couldn't even come up with one strategy that is good enough to trade, because that market basically neutral. There is no edge on that market. So always remember, start with the market and then align a signal using an indicator or a pattern to go along with that market tendency. If you like this video, then you will love the next one.